Good day. This is Brett Johnson of OneMedRadio in New York City. Today we are with Tim Keating, founder and CEO of Keating Capital, a Colorado investment firm that recently raised $86 million in an initial public offering for the purposes of investing in pre-IPO companies. Keating expects to be listed as KIPO on the NASDAQ in December of this year. Tim, thanks for joining us.
Thank you, Brett. Appreciate you having me.
So can you tell us a little bit about the concept of Keating Capital, or KIPO as it will be listed, and where you came from and what your business is?
Absolutely. So Keating Capital was formed 2 years ago, and the idea was to create an access vehicle for investors to participate in pre-IPO investments. And at the time that we formed the fund, there was no other pre-IPO vehicle in the marketplace like Keating Capital. There were a couple of similar funds a decade ago back in the bubble years, and I'm sure we'll get around to talking about those, but there was nothing like Keating Capital, and really there's a couple reasons for that, and I think the main one is that for 5 of the past 10 years, namely 01 to 03 and 08 to 09, there was a very, very bad IPO market, so it wasn't an obvious opportunity to create a pre-IPO fund.
I got you. And so what's your sense about where the business will be and what you're going to really accomplish with this?
Well, I think there's been a dramatic change in the IPO market, and just to rewind about 15 years ago, if you look back in the mid-'90s, the average market cap of a company going public was about $100 million, and a typical company was raising $10, $20, $30 million. If you fast forward to today, the average market cap of a company going public is over $1 billion, so that's over a 10 times increase in a little over a decade, and the average company is raising anywhere from $200 to $300 million in the IPO market. So what's happened now is the size of the companies has grown dramatically larger, and many of these late-stage private companies are doing a final round of financing that is typically restricted to a very narrow universe of potential investors. So the idea behind the vehicle was to create access for an ordinary or average individual investor to be able to participate in these pre-IPO investment opportunities.
What changed?
There were a couple things that changed. The main one, one of the main ones was back in the 90s. There were 4 firms that were very active in taking emerging growth companies public, and they were referred to as the 4 horsemen, and they were, in no particular order, Hambrick and Quist, Robbie Stevens, Montgomery, and Alex Brown. And what happened over the course of the last 15 years, there has been tremendous consolidation in the investment banking underwriting industry, and gone are the 4 horsemen, gone are people like Bear Stearns, Lehman Brothers, and a host of other firms. So now in today's market, there are 4 firms, which we actually refer to as the final 4, and those are Goldman Sachs, Morgan Stanley, J.P. Morgan, and B of A Merrill Lynch, and those 4 firms account for the vast majority, 2/3 or more typically, of all IPOs. And if you look at the size of those firms, really what's happened is a lot of the smaller firms have disappeared, merged, consolidated, what have you, and what you're left with is 4 investment banking behemoths who really control the IPO market, and from their perspective, it doesn't really make sense to do small IPO deals, so they've got a minimum deal size. So the consolidation of those firms, the size of the remaining 4 firms has really ratcheted up the size of an IPO transaction that makes sense to price for those underwriters.
So you effectively are stepping into that void left by these smaller firms who are doing these earlier underwritings, and there's other companies that have followed into this business. Global Silicon Valley Capital recently did a $50 million raise, and is out now doing a $100 million raise to also invest in these sort of late-stage companies, private companies, venture-backed companies. Do you envision other companies like GSVC to be following into this void? And can you comment about how these capital markets will change and whether firms like yours will fill this gap?
Yes, and we are familiar with GSVC Capital and its founder Michael Moe, who's written a great book, Finding the Next Starbucks. And so I think we have great respect and admiration for Michael Moe and have followed him for a number of years. And specifically, I think both we and GSVC identified that there's a very broken capital formation process, and so I mentioned the 5 barren years for the IPO market over the last decade and the consolidation that's occurred, which has caused the size of transactions to increase. And so another factor that's very important is you have a venture capital industry that has literally thousands and thousands and thousands of companies, many late stage. And the reason there's so many late stage companies is a decade ago, the average time from funding to an IPO exit was a little over 3 years. Now that average time is probably somewhere between 10 and 12 years. So you have many older, much more mature, very late stage companies that are looking for an exit. And because the underwriters oftentimes require these late stage private companies to do a final round of financing for purposes of window dressing the balance sheet or giving them some strength in terms of coming to the market, the size of these final rounds of financing has grown larger and larger. So I think there's clearly opportunity for Keating Capital, for GSVC, and perhaps others. And I think the other phenomenon that's worth mentioning is the development of the secondary market in places like SharesPost and Second Market, which have emerged as really a mechanism to create secondary markets in some of these private companies that in a different era or decade would have been normally prime candidates for doing IPOs.
So if you go back to the boom of around the 2000, there was a couple very high-flying stories, Internet Capital Group and CMGI, who saw their stocks go from very little to $200 and $40, $60 billion valuations. So there's been some history of public enterprises entering the business of getting into acquiring securities in private companies and trading. Can you compare and contrast, the Internet Capital Groups and the CMGIs of the 2000 time frame with what you and GSVC are doing?
Absolutely, and I think it's a great question, Brett, and thanks for asking. I think the common approach to Internet Capital and CMGI 15 years ago compared to Keating Capital and GSVC today is a recognition that there is a significant valuation differential that exists between private companies and public companies that are of comparable size and growth and profitability. And the reason that valuation differential exists can be described in 2 words, and those 2 words are liquidity premium. And what that means in plain English is that investors are always willing to pay more for $1 of earnings when a company is publicly traded. Why? Because when a company is publicly traded, the investor has the option to sell instantly, has the option to have instant liquidity. And what's remarkable is the size of that valuation differential. And we've studied this for the last 10 plus years, and there's a constant valuation differential. And typically, a public company is generally valued 2 to 3 times higher than a similar private company. So now, to circle back to your question, so Internet Capital and CMGI, I believe, were founded on the concept of investing in these private companies with the expectation that when the private companies became public, there would be a significant step up in valuation. And that indeed is exactly the premise of Keating Capital. Where the strategies depart is as follows. CMGI and Internet Capital became very active in investing in concepts and stories and companies that had business plans but no revenue, no customers, no earnings. And if you fast forward to today, Keating Capital, for example, is investing in some very substantial late-stage private companies. And so these are companies that have been around for anywhere from 5 to 10 years on average. They often have very significant revenue, in many cases very significant positive cash flow or earnings. And so if you go back to Internet Capital and CMGI, they invested in these concept stocks which had got sky-high valuations when the companies went public, but just as in with musical chairs, when the music stopped, there were no underpinning earnings to support the valuations of the portfolio companies of Internet Capital and CMGI. The stock prices of those companies collapsed, and the stocks of Internet Capital and CMGI also collapsed, corresponding with the decline in prices of their underlying portfolio companies. The difference with Keating Capital is that we are investing in company with revenues, and we're doing it with a valuation discipline. So specifically, we're looking at where a private company we're traded with or we're public, and attempting to invest at a 50% discount to that valuation. Now, obviously, we're going to make mistakes. We're not going to be right in all cases, but at least there is a value discipline framework that underpins all of Keating Capital's investing activities.
Mm-hmm. Can you give us sort of an example of some of the companies or one of the companies that you've invested in recently and how you valued them and where they are today?
Sure. I'll give. I think perhaps the one of the easier companies to look at is a company that we invested in a year ago called Solazyme. And Solazyme is a very exciting company that is in the business of converting ordinary algae to different types of oils that can be used in fuels and chemicals and cosmetics and nutritional products. So an absolutely extraordinary company in every respect. So clearly a clean tech biofuel company. So when we looked at Solazyme, we looked at where we thought it would be traded if it were public, and there was a relatively small set of comparable public companies, but there were some. And many of those companies were valued on a discounted cash flow technique based on an expectation of their revenue and earnings over time. But we had a number of good reference points to compare Solazyme to other public traded companies. So we made an investment in Solazyme in their final preferred stock round at a price of $8.86 per share. The company ended up going public in late May of this year at about $18 a share, and has generally traded up north of $20 a share, and has held there pretty consistently. So it's been a surprisingly unvolatile stock. When I say surprisingly, just because almost all IPO stocks are much more volatile than normal. But that's an example of a company, a clean tech company doing some very exciting things that had some real revenue. They had about $37 million of revenue in their previous fiscal year. So it wasn't just a concept. It was a well-executed science-based with some real revenue. And then the company today is trading at a valuation similar to its peers, but it's a very exciting growth company that's tackling a big problem in a very innovative way. But there was a basis for us determining a value to invest privately, and in this case, so far, it's worked out nicely for us.
Terrific. So can you sort of give us what sort of the optimal company would be, revenues in the $20-30 million range, like a Solazyme, or what's the range of companies that you'll look at?
The range of companies, and we're really looking for three things. The minimum revenue is absolutely $10 million. So we simply won't look at a company with less than $10 million in trailing 12-month revenue. And again, that might not seem like a very high bar, but if you compare that to Internet Capital and CMGI, that might have knocked out 95% of their portfolio companies. So I think the average company in our portfolio right now is somewhere between $60 to $70 million in revenue. They range from a high of 10 up to about $300 million in revenue. They are equally divided between companies that are already profitable and those that are expected to turn profitable in the next 4 to 8 quarters, which is another important thing. The second, so revenue is one, minimum of $10 million of revenue. Second is an expectation of going public within the next 18 months. And third is investing in a valuation that affords us the opportunity to achieve a doubling of our money at the time of the IPO. So a 50% discount is equivalent to 100% return, and our typical holding period is going to be anywhere from 2 to 3 years. So we are targeting a 25% gross rate of return on each of our investments. So if we were able to achieve 100% return on each company and held at an average of 3 years, that would work out to be a roughly 25% internal rate of return. Obviously, we're in a high-risk, high-return business, so some will work out better, many will work out, or some will work out worse, and so that's the average of what we're looking to achieve across the portfolio.
How many companies do you have in your portfolio now, and how many do you expect to add in the coming 12 months?
A mature portfolio for us will consist of 20 companies, each roughly equally weighted at about 5%, so 20 positions of 5% each. As of the date of this interview, we have 9 companies in the portfolio. We expect to add 2 or 3 by the end of the third quarter of 2011, and we'd expect to be somewhere between 12 to 15 companies by the end of the year. So we believe that by the end of the first half of 2012, the portfolio will be close to 20 positions, and at that point, we'll be relatively fully invested.
So would that mean the $86 million that you recently raised will then sort of be pretty much all distributed among your portfolio?
Yes.
And would you expect to go back to the capital markets to do an additional raise like GSVC is doing right now?
It's possible. I think the gating factor for us is we want to ensure that we achieve a couple milestones before we consider going back to the capital markets. Number one, we want to make sure that we're substantially invested. Number two, we would expect a significant number of our companies to have completed IPOs. We would want to have a number of full exits. So in addition to the companies completing their IPOs, we would want to expect it to have realized capital gains on a number of those positions. And then of course, we'd expect our net asset value to increase over time. So when a number of those milestones have been hit, and if we still had as many opportunities as we see today, then yes, we would absolutely consider going back to the capital markets for additional capital.
Well, it sounds like a very exciting strategy and a very exciting time for your company, Tim. Thanks for joining us today.
Brett, thank you very much for the opportunity to share the Keating Capital story with you and your listeners.
Sure. That was Tim Keating, who's the founder and CEO of Keating Capital, a Colorado investment firm. It will be traded KIPO on the NASDAQ later this year, expected around December. Thanks for joining us. Brett Johnson, New York City, for OneMed Place and OneMed Radio.